there! Welcome to another video of Investing Wise Academy. This is Fred, and today, once again, we will look at Cathie Wood's thoughts and opinions about inflation. In a recent episode of the famous podcast, The Know, Nancy Lazar Piper Sandler, the chief global economist, joined Ark CEO and CIO Cathie Wood, and she stated that one of the things we're focused on is what will get the Fed to stop tightening or at least change its rhetoric. She explicitly mentioned the Fed's tightening monetary policy, inflation, and more importantly, consumer mood in the wake of Walmart, Target, and Home Depot's earnings announcements, which were among the largest non-retail chains in the world. In their most recent earnings calls, Target and Walmart indicated that they were experiencing inventory issues. The Walmart CEO admitted that the quarter would be challenging for general merchandise since the firm was competing with stimulus funds from the previous year. Target experienced a similar issue with customers purchasing different goods than the business had anticipated. Inventory estimates are problematic as a result of the epidemic. Typically, a retail chain analyzes its historical data to make inventory decisions and considers any new information. However, according to Ark Invests Cathie Wood, both businesses have a dilemma that can be advantageous for customers but not necessarily for investors in the near future. She anticipates that the recent change in consumer demand patterns will cause inflation to unravel fast. According to her, the equities market would go off once the market realized what was going on. According to her, cyclical and value companies did well last year, but there will be a rotation this year, and growth stocks will be on an upswing. She said, "This is the biggest controversy in the marketplace right now."
So in the former camp that I described earlier, they have inflation really quite sticky up here. And of course, the second scenario that Nancy is describing here has a quick unwind in the inflation. And my confidence in this scenario has increased tremendously after seeing those inventory numbers at Target, Walmart, and Home Depot. I mean, those are very large organizations, national, and they have a very big problem, bigger than I have ever seen.
Additionally, she added that the reason a lot of people think core CPI will be sticky is rents because housing prices have gone up so much. Rents have gone up so much. I think what's going to happen on the good side is going to overwhelm what's going on the rent side. And we're even seeing signs in some places that the consumer just can't pay up for these rents anymore.
You're seeing a lot more mobility, and I have a feeling even rents are going to start adjusting. The stock market is looking very carefully at these numbers to discern trends out there. And as soon as the stock market understands that inflation is going to unravel and that the Fed is actually going to relent, because they are making a mistake here, and I really do believe they are now making a mistake, tightening into the teeth of what seems to be a very significant slowdown and inventory bulge in the economy. I think that the equity market is going to take off again. But what we will see first is a rotation. And, you know, on certain days we're seeing it, but the last year has been all about cyclicals and value stocks.
She also indicates that there will be a rotation back to growth stocks because, if you're right, growth is going to become very scarce out there. And so true growth companies with strong revenue growth in the 20+ range. To the extent there are companies like that out there, they will be rewarded handsomely as the market shifts away from value back to growth. And it can happen very quickly because algorithms are also trained to behave this way.
Last year, it was straight up and to the right for cyclicals and value, and the momentum carried them probably too far, given what's happening with inventories. And the same can happen in the other direction. Everyone's been watching the 10-year Treasury bond yield like hawks, And those in the first camp were sure that it was going to break the downtrend that's been in place. Really, if you go, you have to go back to 1981 to see the beginning of the downtrend. The Treasury bond yield peaked at around 15% back then, and the trend has been down. I think those expecting a breakout are being disappointed as we speak. And I'm surprised that the stock market isn't picking up more on this because interest rates, the long-term Treasury yield, this one, went to 320 and now has backed down to 280. So that's 40 basis points in maybe 2 weeks. Which is a very rapid move. So the bond market, and remember, this is a 10-year Treasury yield, and I always like to think of it in terms of, okay, this is what the bond market thinks nominal GDP will be doing for the next 10 years, give or take. So 3% or 2.8% nominal GDP growth over the next 10 years. Well, that must mean one of two things. Either growth is disappointing or inflation's disappointing or both. Or if you're in our world, in the disruptive innovation world, we think unit growth measured correctly is going to surprise hugely on the high side of expectations, and that inflation is going to turn down. And we would not be surprised over time to see it go negative once more, because disruptive innovation is becoming a much bigger base in the economy. Electric vehicles, when we first started Ark, weren't even, they were probably not even 20,000 vehicles. That was 2014. Last year, we were up at 4.8 million units. This year, we think we could be close to 7.5 million units globally as the consumer preference shift accelerates towards electric. And so, that's approaching 10% of all auto sales. And we know that the dollar is up 15%. That's a powerful anti-inflationary force. We mentioned the 10-year bond yield, saying, Fed, you might be making a mistake here. And we're beginning to see that in other fixed income metrics, like the yield curve. The yield curve has flattened from 150 basis points more than a year ago down to roughly 20 basis points. It went negative for a minute, but what this also means is the bond investors believe that inflation or growth is going to be disappointing. So that's interesting. Typically, when the yield curve goes negative, there is a recession within the 12 to 18 months. And that's certainly post-World War II experience. If we're right, we're going to revert to something like the early 1900s experience, where if these deflationary forces start dominating, that we could have inverted yield curves more often than not. In the 50 years ended in 25, the yield curve was inverted 60% of the time, and the average inversion was 100 basis points. That certainly will be a new world. And I think the other variable we're seeing here, credit default swaps, those are breaking out. These are insurance policies that investors take out against bankruptcy. And even JP Morgan, I took a look at that. Now, banks are very well capitalized. We're trying to figure out why this is happening. But JP Morgan's credit default swaps are priced today above where they were in the fourth quarter of 2018, when the market absolutely fell apart, and are moving towards COVID highs. Now, why is that happening?
Additionally, she said that, I think there are a lot of deflationary forces out there. And if there are deflationary forces and a company has leverage up to buy back shares and cater to short-term oriented shareholders, then they are going to have to service that debt by cutting prices on products that are probably going obsolete or that are over-inventoried right now.
So I think we're going to hear a lot more about deflation, and I think you should watch very carefully the leverage in your companies and whether or not their products are in an over-inventory situation, or whether they're going to be obsolete because of innovation. And I'll just give one more example. We got another report this week. Cisco Systems, technology bellwether, not so much a technology bellwether, but a GDP bellwether. That's at least how it describes itself. Its revenues trade much like nominal GDP does globally. And expectations for this last quarter were up 5.5% in revenues. They were flat. Their revenues were flat, and they cut their estimate for the next quarter from 5.5% to anywhere from -1.5% to -5.5%. Now, what is that? Is this a GDP harbinger? It might be. We do think GDP is going to slow down quite a bit. But in our view, here's disruptive innovation at work once again. We are going through the first rip and replace cycle, capital spending cycle, in the enterprise communications space since the early 90s, when Cisco was building out the backbone for the internet. Now Cisco is being disrupted. So it is very much hardware centric and on-prem in its focus. Enterprise communications, like all technology, is moving into the cloud. And I often say it's going to feel chaotic because even our economic statistics are not set up for what's about to happen. They were born out of the industrial age, and they're having trouble measuring the digital age. They're missing a lot, and it takes them 5 to 10 years to catch up to reality. And in the meantime, they have all of the tax information on income and profits generally out there. So what we think is happening is the GDP statistics are, as they are reported today, are showing higher inflation than is really the case and lower output growth than is the case.
Also, she stated one of the things we're focused on is what will get the Fed to stop tightening or at least change its rhetoric. And so, again, confusing to the Fed, confusing to everyone, but not confusing to us, because we're focused solely on disruptive innovation. Cathie Wood ended the talk by saying innovation is going to solve a lot of our problems. Well, what do you think about what Cathie Wood has said? Let me know in the comment down below. But again, if you are new to this channel, please subscribe to be updated for more upcoming videos like this. This is Fred from Investing Wise Academy. Thank you for watching and see you again.